We are constantly told that the banking system has never been stronger. Yet the International Monetary Fund just released a warning that you should not ignore. The IMF says that banks in the United States and the United Kingdom are deeply exposed to private credit institutions. That matters because we are starting to see more defaults inside that private credit world, and those failures are already spilling back into the banking system. If those defaults keep climbing, the IMF believes it could set off a chain reaction through the banks. So let me walk through exactly what is going on and why it matters for you. The IMF is one of the organizations that keeps an eye on the global financial system. In its latest Global Financial Stability Report, it added a line that should make you pause. They wrote that under the calm surface of the financial system, the ground is moving in ways that create new vulnerabilities. The question is what those vulnerabilities are and where they are hiding. Right now, banks in the United States and the United Kingdom have around $4.5 trillion of exposure to hedge funds, private credit funds, and other non-bank financial institutions. A non-bank financial institution is not a traditional bank, but it behaves like one in some important ways. It lends money, it finances deals, it takes risk, but it does not operate with the same rules and protections that regular banks must follow. Here is how the structure works. Big banks provide credit lines, financing, and other forms of funding to these non-bank financial institutions. Those non-bank players then go out and lend money to households and businesses. They might be financing a person buying a car, or a company looking to expand, or a private equity deal. The risk sits on the balance sheets of those non-bank lenders, but the money behind them often comes from the banks. The IMF is warning that banks may now be too exposed to this part of the system. When everything is going well and loans are being paid, this setup looks great. Banks earn higher returns on their capital, the non-bank institutions collect their fees and interest, and investors chasing yield are happy. But the IMF is now seeing more stress in this shadow part of the system. Defaults are rising, some of these lenders are running into serious trouble. And that is where the concern begins. We have already seen a few examples. A subprime auto lender called Tricolor recently went bankrupt. Soon after, another company called First Brands also collapsed with billions of dollars in loans essentially vaporized. In the case of Tricolor, the fallout included a loss of around $200 million for Fifth Third Bank alone. That is just one bank and one name. When central banks and global institutions see stories like this, they start asking how many more are out there and how much exposure the banks truly have. The IMF highlights three main reasons this situation is worrying. The first is simple size. The exposure of banks to these non-bank financial institutions is massive. The IMF estimates that banks in the United States and Europe have about $4.5 trillion of exposure tied to this shadow system. It also notes that lenders with non-bank exposures larger than their own capital now make up more than 40% of total banking assets. That is a stunning figure. It means that a large portion of the banking system is sitting on exposures that could wipe out their capital if enough of those non-bank loans go bad. The second issue is regulation, or more accurately, the lack of it. When you borrow money from a regular bank, that bank is operating under strict rules about capital, liquidity, underwriting standards, and risk. They are monitored by regulators and operate under deposit insurance systems that are ultimately backed by taxpayers. Non-bank financial institutions do not live under the same rulebook. They do not take deposits in the same way, and they typically do not have the same detailed supervision that traditional banks do. Because of that, they can reach further out on the risk curve. They can lend to weaker borrowers, structure more aggressive products, and chase higher returns without facing the same restrictions that a regulated bank would face. Hedge funds have already pushed back against calls for tighter oversight. They argue that they are less leveraged than banks and that they do not benefit from government-backed deposit guarantees, so they do not need the same level of scrutiny. That might sound reasonable until you remember that these funds are still funded in many cases by the same banks that do have those protections. The third issue is incentive. Everyone in this chain wants to make money. Non-bank institutions want to grow their loan books and earn higher returns. Banks want to juice their profits and boost their return on equity. Investors are desperate for yield in a world that has been shaped for years by low interest rates and easy money. In that search for yield, underwriting standards often slip. The IMF notes that many lenders chasing returns have become less careful about the quality of the loans they are writing. That means non-bank lenders are pushing out more aggressive loans because they see big profit potential. Banks keep supplying them with funding because the returns look attractive on paper. No one wants to be the one that pulls back and misses the party. The problem is that all of this is happening while those same loans are growing riskier. When one borrower defaults, it hurts the non-bank lender. When enough of those borrowers default, it starts to hurt the banks that finance those lenders. At that point, what looks like a contained issue inside the shadow system becomes a bigger problem for the entire financial sector. We have already seen that in the case of Tricolor, its bankruptcy triggered a direct hit for a major regional bank. Now imagine similar losses rippling through dozens of institutions tied into private credit funds, auto lenders, real estate financing, and other risky sectors. The IMF is not saying that a full meltdown is guaranteed. It is saying that the vulnerabilities are piling up in a corner of the system that does not get enough attention until something breaks. The Financial Times recently summarized the trend by explaining that banks are increasingly lending to private credit funds because those loans deliver higher returns on equity than traditional lending, thanks to lighter capital requirements and the way the collateral is structured. In plain language, these arrangements let banks earn more money for each dollar of capital they commit, that is, the carrot. The risk is what happens when the cycle turns. If the economy moves into a deeper downturn, those higher return loans can suddenly become higher loss loans. The IMF and other observers worry that in a real downturn, investors in these private credit products will begin to ask for their money back. Many of these vehicles offer redemption features that sound appealing when markets are calm. But if too many investors try to exit at once, these funds may not have the cash to meet those redemptions. They could be forced to sell assets at fire sale prices or suspend withdrawals altogether. That is where stress in the non-bank world can quickly bounce back into the regulated banking system. History shows that when money is easy and everyone is making gains, people rarely look for hidden problems. It is only when liquidity dries up and defaults appear that fraud, weak underwriting, and bad loans are exposed. We saw that in the last housing bubble and in other credit booms before that. The same pattern can repeat wherever the hottest new source of yield is hiding. So what is causing the strain right now? A major driver is the move from ultra-low interest rates to a world where money is more expensive. Yes, the Federal Reserve has cut rates a couple of times in 2025. But even after those cuts, interest rates are still far higher than they were a few years ago. Those higher rates increase the cost of servicing debt for borrowers at every level. Now take that environment and combine it with riskier loans, persistent inflation, a cooling economy, and a softening job market. Households and businesses that were already stretched start to fall behind. They miss payments. They default. Those defaults hit the non-bank lenders first, especially in riskier segments like subprime auto loans and weaker corporate credit. As those losses climb, they start to squeeze the banks that funded those lenders. That is why the IMF is focused on these linkages. A surge in defaults in private credit does not stay contained in private credit. It feeds back into bank balance sheets, investor confidence, and ultimately the broader economy. The big question is what all of this means for you as an investor. The first answer is volatility. You should expect ongoing volatility whenever there are debates about interest rate policy, when new defaults hit the headlines, or when regulators highlight new risks around banks and non-bank lenders. Sharp swings in markets are likely in that kind of environment. But volatility also creates opportunity. Warren Buffett has a famous principle. Be fearful when others are greedy, and be greedy when others are fearful. When fear takes over a sector, good assets can get dragged down along with the bad. If investors panic at the sight of rising defaults in private credit, they may dump bank stocks across the board without understanding which institutions are actually vulnerable and which ones are solid. That broad selling can push down the share prices of strong banks that have manageable exposure and good risk controls. For patient and informed investors, those moments can offer a chance to buy quality assets at discounted prices. The same logic applies if a serious scare in private credit spills over into the wider market. There are funds that track the S&P 500, banks, financials, or other specific sectors. A wave of fear can drag those funds lower even when the long-term fundamentals remain intact. We have seen this pattern many times. In 2022, when the stock market dropped around 20%, many people rushed to the exits while more experienced investors used the decline to accumulate shares of solid companies. In 2020, when markets fell about 35% in a matter of weeks, panic selling dominated the headlines while disciplined investors were buying. In 2008, when the housing market collapsed and the stock market plunged, it was the same story. Those who had cash and courage to buy during the chaos saw huge gains in the years that followed. The same thing happened after the dot-com bubble burst in 2000 when many people claimed the internet was finished. The investors who saw through the panic and bought strong businesses at cheap prices were rewarded later. You can choose your own level of exposure. Some people pick individual companies, which offers the highest potential return along with higher risk and more work. That approach requires real skill in analyzing businesses and reading financial statements. Others prefer broad funds that hold hundreds of companies at once. That lowers the risk of any single company blowing up and lets you ride long-term market cycles. The goal is not to perfectly time the next downturn. Almost no one can do that. The smarter move is to build a strategy that has you investing consistently while also keeping some money on the side so that you are ready when markets drop. If you know that recessions and market crashes are part of the normal cycle and that they have happened roughly every decade for a century, then a future downturn is not a surprise. It is something you can plan for. Right now, we have a very strange mix of forces. The IMF is warning about banks and non-bank lenders. There are trade tensions, worries about inflation, concerns about slowing growth, and fears about job losses from artificial intelligence. At the same time, many asset classes including stocks, real estate, gold, and crypto are near record highs. We also know that the dollar faces its own long-term questions and that debt levels keep rising. Taken together, it is almost certain that we will face another recession and another market correction in the future. The timing is uncertain, but the cycle is real. Once you accept that, you do not have to panic each time you hear the word recession. You can focus instead on preparation. Build your financial base. Keep learning and position yourself so that when the next wave of fear hits, you are in a place to act rather than react. Because when there is real economic pain and real volatility, that is when many people lose money. But it is also when prepared investors build wealth. And if you found value in this breakdown, the best way to support the channel is to share this video with a friend, a family member, a coworker, or another investor who needs to understand what is really happening inside the banking system. Thank you for watching. Please like and subscribe if you found this helpful.